Okay, everybody, same deal as yesterday. I'm going to run through the practice exercise solution for activity 6 is adjusting entries because there's 5 more that you have to have a pretty good handle on to continue on with the assignment at the end of this activity that's due at the end of today. So, first and foremost, number one, shoot, number one, Company B, okay, pays their employees $5,000 every 2 weeks or 10 workdays. The year end is December 31st. The employees were last paid on December 27th. So off to the side, which I always like to use as a place to do some calculations, I realize that we have the 27th, 28th, 29th, 30th, and 31st of December. That's 1, 2, 3, 4, 5. 5 days that we owe the employees money for. Well, they get paid every 10 days. So we take 5 divided by 10, pardon me, and we multiply that by whatever they're paid for. In this case, it's the $5,000, which I find sitting right here. All right, and that gives me a grand total of $2,500 that the company owes the employees for the 5 days they work before the year end. You have to account for that. Year end is December 31st. Our debit will be to salaries expense, and our credit is going to be to salaries payable, both for $2,500. And our description is going to say to adjust for salaries payable. Okay, so that's how we handle question number one. Number two, Company Q has invested $5,000 into a secure investment that will pay at 5% on an annual basis. This interest is paid on August 31st. The company's year end is October 31st. So we're dealing with a different company, different year end. Okay. Now, a couple of things we need to realize. The company took $5,000 of its own money, put it into something that's going to earn it 5%, and they get paid that interest on August 31st. So August 31st basically works out to September. And then we have all of October. So there's 2 months, right? Because the year end is October 31st. 2 months out of the 12 where they're going to earn, where they have earned interest before the year end. We multiply that by the $5,000 they put into the secure investment, and we multiply that by the 5%. Now, that gives us a grand total of $42. Now, I think it's $41.65, something like that. Look, for our purposes, let's not mess with the pennies. Just round it up. I'm okay with the $42. If you wanted to put the pennies in, I'm not going to fault you for it, but just keep it simple. I like to just round it up to the nearest dollar. Pardon me, it's not December that we're working with. It's going to be October 31st. Let me change my pen here for a quick second. All right, and the debit we're going to use is accrued interest. Now there's a term that I just want to take a quick second and underline and talk about is accrual. An accrued interest is something that builds up over time. Just like with the salaries expense, we're going to accrue some interest that we've earned on the investment that we made on August 31st, and it's accrued to October 31st. And that's the $42 that we calculated. It's also, as a credit, interest revenue. Okay? And we're going to say to adjust for interest revenue. This is going to get tight here, guys. Okay, apologize for that tightness down below. Okay, now moving on. 3 and 4 both deal with amortization. Amortization is also known as depreciation. During the course of this video, I might switch my dialogue to say depreciation instead of amortization. It is the exact same thing. It's just a different way of saying it. So amortization, depreciation, whatever you learned last year, whether you were taught amortization or depreciation, we'll just call it amortization for the purposes of this course because in all of the literature on the course site, everything is called amortization. All right, so we're going to use something called the straight line basis, which is pretty straightforward and pretty simple. Company C amortizes their assets on a straight line basis. Their truck costs the company $10,000 and has a salvage value of $2,000. The useful life of the truck is 8 years. The year end is December 31st. Well, if we're using straight line basis, our formula is going to be cost minus salvage value. I'm just going to write the word salvage. And you divide that by years of use. So our cost is $10,000. Our salvage value is stated at $2,000, and the years of use is 8, which means that we are amortizing this asset over $1,000 every year. Let me tidy that up. So that means that every year you use this asset, you are decreasing the value of it by $1,000. So our journal entry at December 31st is going to be to depreciation expense, and then, pardon me, not depreciation expense. Pardon me. See, I already did it. I knew I was going to do it. Amortization expense. My apologies. But like I said, they're synonymous with each other, so using one or the other doesn't really matter. And then our credit is going to be to accumulated. I just go with ACC, but that's short form for accumulated. Amortization, I'm just using the short form for amort. Please feel free to do the same thing. Dash, and I make sure I list the asset here, truck. You'll notice that I just put it to amortization expense up top. Some textbooks, some teachers might want you to put amortization expense truck at the end. I'm okay if you don't do it. I think all amortization should go under the same expense, so just leave it as it is. There's no need to classify it as amortization expense truck. That's a debit for 1,000. Accumulated amortization is a credit for 1,000. To adjust for truck amortization. Okay, again, I'm sorry about it being a little bit tight in there. All right, on to the next one. This is our second method of amortization. It's called the declining balance method. Its formula is actually much simpler. You take the cost and you multiply that by the depreciation rate or the amortization rate, whatever we've given you. Okay, in this case, they've given you 20%. Now, that's in year one. We're only going to worry about year one right now. When we get later on in the course, we'll have a great big long schedule about how to calculate this stuff out for year 2, 3, 4, et cetera, et cetera. But for today, we're just worried about buying it in year one. So our cost, our amortization, pardon me, of this asset is going to be 15,000 times 20%. And that number comes out to $3,000. Okay, the year end is May 31st. Amortization expense is our debit for 3,000, and our credit is going to be accumulated amortization, and this time it's for it's for an automobile, so we write automobile or auto, and that's a credit for $3,000 to adjust for auto amortization. And it's getting a little tight down there. Okay, so that's the two amortization methods that we're going to use in this, at least for this time period, at least for the time being. Straight line basis and the declining balance method. But remember, the declining balance method will just and always be the first year for the time being. Okay, last example. Company A clever name, has a year end of April 30th. At that time, the accounts receivable ledger balance is $10,000. So if you look at the T account, the balance is actually $10,000 on the debit side. Unfortunately, you can't always collect on that $10,000. Some people are just going to be delinquent payers. And it's estimated that 2% of that balance will not be collected. The allowance for doubtful accounts currently has a ledger balance of 50 bucks. Okay, so just bear with me here for a second. Your ledger account for your accounts receivable is going to be $10,000. Okay, it's a debit balance. It's after all the transactions have been taking place over the course of the year, the fiscal year. Your allowance for doubt accounts, and that's tight and messy, I know, but that's your allowance for doubtful accounts. That's actually a credit balance. On the balance sheet, it actually ends up listed right beneath the accounts receivable because it's supposed to act as a contra account to accounts receivable, much like accumulated depreciation does for a capital asset. Well, that's already got a balance of 50 bucks sitting in it on the credit side. So when we go through and do our calculation, what we need to figure out is of that $10,000, how much is going to be uncollectible in a dollar amount? Well, we know 2% is going to be uncollectible. So that works out to 200 bucks. Okay, great. What we need to do is we need to get this balance to $200. Well, it's already got 50 bucks in it, as I said, right here. So we need to credit that for $150. And I apologize again for how messy it's getting, but that's what we need to move allowance for doubtful accounts from the 50 bucks to get it up to the $200 that it is by crediting it for $150. That is our adjusting entry. April 30th, we debit something that you've never heard of before, at least in this course so far, bad debt expense. All right, so we do have an expense for the bad debt that we're just not going to get our money back for. And we're going to credit allowance for doubtful accounts. Our bad debt expense is going to be not for the 200 we calculated. Don't do that. You're going to take this number here, the 150, to move this account here up to that $200 balance, which we want to get it to. Okay? All right. And then you just describe it to adjust for doubtful accounts. Hopefully that makes those 5 clear. Once you've got a good grasp on those, start on the assignment for activity 6. This will be worth marks. It includes and encapsulates all of the adjusting entries we did here, plus the ones we did yesterday. If you got any questions, I'll be online. Good luck.